Good evening, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, the S&P and the QQQs hitting brand new all-time highs over the course of the morning. However, throughout the day, round-tripped everything and unfortunately ended in the red. Now, coming into this week, we knew that we were going to have volatility coming at us from all sides. Number one, due to the sheer amount of macroeconomic data points that we'll be getting throughout the week. But number two, due to the sheer amount of earnings that we are also going to have to contend with too. And we were also establishing that since the market currently is priced to perfection, a very strong rally underway, the bulls are in control, but we are in slightly overbought conditions. With the market being somewhat priced to perfection, any one of these macroeconomic releases that comes out slightly negative, or some of these big earnings results that will come out slightly negative, well, those are going to be a perfect opportunity for the market to possibly go into a bit of a consolidation day or a consolidation phase overall. And today was a case of just that. In terms of what we had for macro, the reason that the markets kind of fell off in the early hours of the morning was because you got one report at 10 a.m. It was the JOLTS job openings report that showed that, sadly, there was around 100,000 jobs less than anticipated in the economy for people searching for work. So, of course, when you have a less than perfect jobs report that comes out, well, when the market is priced to perfection, you are going to kind of sell that off. It's a good thing that the market was able to kind of normalize throughout the rest of the day. However, on the other front, we had a bunch of companies that reported earnings, and you can see the results of those earnings right here. A lot of these companies didn't do too bad, but we know so far in earnings, it's been a tough crowd. Even when companies have decent numbers, their stock can go down. NVO was a prime example of this. Well, not that point, but NVO actually posted a preemptive somewhat earnings release. Well, they didn't really post earnings, but they posted EPS guidance, slashing their end of year guidance because of competition in the GLP-1 space, referencing the higher amount of compounding drugs for GLP-1, something that they've been accusing HIMSS of selling earlier on just a few short weeks ago. That stock was down 22% and did bring down another major healthcare player in the space, Eli Lilly. So that contributed to bringing down the healthcare space overall. In other news, we have Spotify, which had earnings down 12%, UPS down 10% on their earnings. Brown, an insurance player that never usually moves this much, they were down 10%. They had good earnings, but they also did a $9 billion acquisition, so that did bring them down. The company's only worth about $30 billion, so that did bring them down a little bit. VeriSign giving back almost all of their earnings gains and even more. PayPal down 8.6, UNH down 7.4, and the list simply continues, guys. A lot of names ending deep in the red, and some of the companies that reported earnings, sadly, they did bring down some of their sector peers, which we call sympathy plays. So those other plays were kind of selling off in sympathy to the ones that did report earnings. Overall, a very mixed day in the markets, which leads us to the following conclusion, which I've talked about over the course of the past 1.5 weeks. Just to do a summary, now that we're kind of deep into earnings season, what has been happening, guys? Well, it all comes down to the fact that the market has been roughly priced to perfection, and a lot of these companies leading into this earnings season are up 20, 30, 50, 100% from the April local lows. So they have to show really good numbers, or it's going to be a tough crowd. Wall Street is currently using any excuse under perfection to drop these companies. We can just look at a few examples, right? IBM, we covered these on the channel. Decent earnings, down 8%. Fiserv had pretty strong earnings, although they missed organic revenue growth by a couple percentage points, not the end of the world. This one made a almost 4 standard deviation move to the downside, 22% before recovering, about 8-9% of that. But still, I didn't think the earnings were that bad. We covered it on the channel. MSCI, fantastic company. They had earnings. They were down 9. MSCI rarely moves down 9% for any which reason. Texas Instruments, their earnings were not too bad. Covered those on the channel. They were down 12%. And then we have all the ones that came a few weeks ago. American Express, they had good earnings on the day of earnings, despite showing growth across all segments. They were down 3. The banks, you guys remember the banks? The banks had fantastic earnings, went down initially, but then the markets kind of bid them back up. But the initial reactions have not been too good, right? Even JP Morgan had pretty good earnings. The market sent them down after earnings, but then bid them up thereafter. So that's the type of things that we're seeing, right? But on the day of earnings, sometimes they can get some bad beats. ASML, another one we covered on the channel, just because the CEO said that they're still planning for growth in 2026, but they cannot confirm it. It's not as if he said there's not going to be any growth. He just said, yeah, we're planning for it, but I don't want to actually say that on the earnings call. This stock has been down ever since, coming down double digits essentially, right? Then we have Micron that had fantastic earnings. Their stock has been down almost every single day for the past 3 weeks. Shall I go on? Take a look at Netflix. Netflix had great earnings. They've been down pretty much almost every single day since their earnings. But some of these companies had just ran a ton leading into their earnings. So anything under absolute perfection right now, guys, is just getting sold off. If you have absolute perfection in terms of earnings, which we've seen, even that is sometimes not enough. Google had absolute perfection. They rallied 3-4%, gave it all back, and now we're coming back a little bit. ServiceNow had absolute almost perfection on their earnings. They had the pop and the drop, and now we're starting to bid it back up. Decker's Outdoor Brands rallied 15% when they said that, yeah, tariffs are not impacting our business that much. 15%, they've now almost given back more than half of that. And even Taiwan Semiconductor, which showed arguably some of the best earnings that the semiconductor season has seen so far, well, they had fantastic earnings, gave it all back, and now we're just hovering around. So you can clearly see a common theme in relation to last quarter. Last quarter, the bar was set very, very, very low. And whenever you were beating and you were saying, yeah, we might not be affected too much by tariffs, your stock was going up and a lot, even if the numbers were not too fantastic. Now that the markets are kind of priced for perfection, we've seen tremendous rallies over the course of the past 3-4 months. If you show anything under perfection and raise guidance by an amount that Wall Street wasn't even considering, your stock will sadly move down. So maybe that sets the tone for the rest of the earnings season, which is why I still do advise, and I've been saying this now for several days in a row, guys, be very careful. Even the most solid companies leading into earnings, if they have rallied a ton, they can show very good numbers and still go down, which is why I always say earnings is an absolute casino, right? Companies can post very good numbers and go down. Companies can post very bad numbers and somehow still go up, right? So keep that in mind for earnings. This one might be a little bit of a, very volatile next few weeks for this earnings season overall. So that's it for the introduction, guys. I really wanted to drive that point home. But in terms of today's video, what we're going to do, I have four company earnings that we definitely have to talk about. Number one is going to be, well, sadly, I can't find my earnings page. Give me a sec. Okay, so sorry about that. It's right here. Today, we're going to talk about 4 companies, guys. We're going to talk about SOFI, PayPal, Visa, and we are going to talk about Spotify. So those are going to be the 4 companies. Special shout out to other ones such as United Health, Starbucks, Booking Holdings, and others. Maybe we can catch some of those up on the Friday session, but there's just too many to cover. So I figured I should cover the ones, that may be most relevant to the retail sentiment or the retail trade. So we'll take a look at those 4 companies to start it off. Thereafter, we're going to take a look at our technical analysis. Where do we stand now that the markets are a little bit choppy? Now that we know that we have so many more macro events the rest of the week. Tomorrow, jobs, GDP, Jerome Powell, and then on Friday, the non-farm payrolls. How are the markets shaping up into these earnings releases? And if the worst case scenario happens, where can we possibly go? So we'll take a look at some of the major indexes and derive some levels of interest there. Thereafter, we will do the exact same thing on our big tech names because we know that big tech is going to have a crazy week. Tomorrow, Meta, Microsoft, Thursday, Apple, and Amazon. So we will derive some potential levels of interest, whether those earnings are well received or not well received by the market, and see if we can establish some nice zones for some swing trades or some long-term portfolio buys. At the end of the video, I'll be taking you guys through a few of the companies on our biggest gainers and losers of the day. But since today we're going to be spending a lot of time on earnings, I don't expect to spend very much time on this section, sadly. So that being said, that's everything for your today's video. Let's jump right into the action, shall we? So the SPY down about 0.26, the Q's down 0.15, and overall, as I've been saying, it was a very choppy day. We did have some names in the green and some sectors, overall, a lot more names that were green than red, but sometimes the weight of the names that were down in a certain sector contributed to bring the whole thing down, yeah? So big tech, very, very mixed day. Only Google making it out alive. Shout out to Broadcom and AMD. They were doing their best to hold up semis, but NVIDIA, just too heavy there to the downside, right? In terms of financials, they were sadly down overall. Healthcare was a mixed bag. Consumer defensives, not too bad. And the bottom half of the market, well, industrials not having the best time at all, but real estate, utilities, utilities and energy not performing too poorly because we did have a decent little decline in yields today. And a lot of those are interest rate sensitive, right? So moving on to the one-day relative performance, you will see this even better to where the market was pretty much split down the middle. Real estate, energy, utilities, and defensives higher, but everything else, especially some of your more growth-oriented sectors, sadly tracing to the downside, or tracking to the downside rather. 1 week relative, we are still somewhat green overall in the markets. Energy, tech, industrials, and financials doing their best to hold up the S&P, and sadly all the other major sectors to the downside. Still looking good on the 1 month relative though. We are going to close the monthly candle on Thursday. So after a very strong month of July, we knew that coming into this month, seasonality definitely does favor us. July is the second best month of the year overall. We then know though that the fall season, August through October, can be a little bit choppy, which is why I've been reiterated, especially now that the market's priced into perfection. You got the S&P at overbought conditions. You can clearly see what's going on with earnings right now. Things have ran a lot. So if you have any short-term bets, talking about short-term call options, good for August and September, and you're sitting on a lot of gains right now, maybe not the best, maybe not the worst idea to take some of those profits. I'm not saying close all of the position, but if you have 5 call options, maybe you close 3, maybe you close 4, maybe you close enough to make the position free and kind of ride the rest as runners. So that is my humble non-financial advice to those of you sitting on some short-term swing trades that are having some very heavy gains right now. So before we get into more technical analysis, guys, let us dive into our earnings releases. And of course, we're going to start off with the one that everybody wants to talk about, which is going to be SOFI. So SOFI having a fantastic earnings release, guys. This was a perfect quarter for SOFI. They beat on absolutely everything, raised on guidance. The stock at one point this morning was up almost 20% before, sadly, we kind of hit the resistance zone. We hit the take profit zone. Maybe a bunch of people have been holding their SOFI shares from all the way back there and just wanted to take some gains and get out. But definitely today was a take profit day for most SOFI investors. And then sadly, after such a good quarter, SOFI did the unthinkable. Well, not the unthinkable, but you guys know, right? A bit of hyperbole right there. They're down 6.65% in the after hours. I have almost never seen a company with an over $10 billion market cap rally 20% after earnings and give absolutely everything back, not only throughout the day, but in the after hours. The reason being, in the after hours, guys, sadly, they did the one thing that nobody ever wants to see, which is they did this right here. Excuse me. If I can find it for you guys. Give me a sec. It's right here. Sorry, I got way too many tabs open. 4 different companies, 5 million tabs. They sadly did a stock offering. So here you go. $1.5 billion worth of shares will be put onto the marketplace. The company is trying to raise capital. Why do they need to raise capital, even though they have positive net margins and positive free cash flow? Well, here's their justification. They intend to use the net proceeds from the offering for general corporate purposes, whatever that means, including working capital and other business opportunities. The company does not have that much debt. They are net margin profitable and having decent free cash flow. But this company did do a capital raise, which kind of really soured the investor sentiment in the after hours. And sadly, SOFI has round tripped the entire almost 20% move, but let that not detract from the sheer quality of these earnings, right? Short term, of course, it sucks, but long-term investors should be very happy about this earnings report because it was fantastic. Let's get into it. Beat on EPS 35%. This is perfection. This is the unexpected thing. That's why they had such a heavy rally in the morning, and a 6.71% beat on revenue. Fantastic numbers overall. Let's do a little bit of a deep dive, and I'll give you my impressions as to whether this one is a buy, whether it's a sell, and all things of that nature, right? So here's your earnings at a glance. Revenue up 43% year over year. Absolutely ridiculous numbers. Member count was increasing by 34% year over year. EBITDA, 81% year over year. So not only are they growing the top line, they are also getting more profitable as they do so. And EPS, 700% year over year gain. I mean, it went from a penny to 8 pennies, so don't look too much into it, but still, the number looks pretty good. Adjusted EBITDA margin. So as I said, as they scale into higher tranches of revenue, they're improving profitability at the same time. These are all things that you want to see as a SOFI investor. Now, moving on into the earnings release, here's what the CEO had to say. We had an exceptional second quarter, driving durable growth and strong returns through our relentless focus on product innovation and brand building. We accelerated adjusted net revenue growth to 44% year over year, the highest level in over 2 years, driven by record new high new members, as well as new products and an increase in fee-based revenue. This consistent, disciplined investment across our platform, combined with unmatched products and services, uniquely positions us to capture the massive and expanding opportunities ahead. Looking forward, we are focusing on innovating faster than ever before to serve more of our members' needs and increasing our financial guidance for 2025. So there you go, beat and raise and super positive commentary from the CEO overall. I'll remind you though, SoFi was not always this diverse. They've been adding a whole bunch of products to their suite, essentially, right? So here you can see they added a record 850,000 new members and 1.3 million products. So really diversifying from the company that they were a few short years ago, where they were specializing more towards student loans and loan origination. Now really having a broad portfolio of product offerings, anything from debit cards, credit cards, investment opportunities, and things of that nature. And by the way, they've been doing a really good job of making their loan business a lot more lean. They used to hold a lot of the debt earlier. They do not do that anymore. They sell the loans that they originate from clients to other larger institutions, such as some of the big major banks that you guys know very well. It allows them to keep a relatively capital light structure, or rather a more capital light structure than they once had. Also allows them to increase margins and reduce the credit risk profile of the business overall. So all things being considered, guys, I think it was a very strong report. You can see some of the financial services that SoFi now offers, from banking, credit cards, investing, and of course, their traditional loan platform. They also generate revenue from Galileo, which is their, business-to-business offering. It's basically just a user interface that they sell to other banks, such as Deutsche Bank. When Deutsche Bank is not happy with their mobile app or their online website, and they don't have the technology to improve it on their own, well, they will use Galileo. It's basically SoFi's platform where they will build your mobile app for you. They will build your client website for you and just improve the user experience. And they've been making some pretty good revenues on that. Take a look right here. Here's your total SoFi lending revenue curve. So you can see that lending is still the largest component of the business. In orange, you have the technology platform revenue, which we're talking about Galileo right there. That's been expanding pretty well. And then you have the financial services non-interest income. So everything else that SoFi has kind of been broadening into, the investing, the credit cards, all things of that nature, you can clearly see a massive shift in revenues here, trying to really diversify away from loans being the main component of their business. Although it still is, you can see that other sources of revenue are now playing a bigger portion, are playing into a bigger percentage of overall revenue, which is a good thing for the company. So let's go through a few more statistics here. Members and products, 51% compound annual growth rate in the last 4 years. This year up 34%, very strong. And the amount of products continues to increase. But I mean, guys, take this with a grain of salt, right? I know it says 17,000 products, but if they offer one stock, that's one product, right? So if they add Apple, Amazon, whatever, they're just adding stocks that counts as one product. So don't look too much into it, but it's nice to see that they have a very broad offering of their product suite right now. Overall, you can clearly see the nice trajectory. SoFi used to be a net margin negative company. They are now at a positive net income trajectory, which is very good, which also allows them to collect more free cash flow. And here you go, the fee-based revenue mix, kind of going away from only interest income from the loans. You can see that the fee-based revenue mix is becoming a larger percentage of the revenue. We saw that on this graph right here, but I just wanted to show you that even more with SoFi's own chart, which is very good. Their adjusted EBITDA margins have been moving higher and higher as they scale revenue too. So overall, guys, I mean, you would be very hard pressed to find anything wrong with this earnings report overall. Here's your financial services segment. Very strong net revenue gains, and margin and profit have been increasing as well. This is the more profitable arm of the business, as we know that the profit margins on loans are okay, but they're nowhere close to being as good as your financial services segment. So that's a good growth driver for the profitability of the business overall. You can see here as well, I just want to bring you down to the lending segment. You can see the contribution margin and profit is now representing a lesser amount of total revenues and total margins as financial services starts to kind of give them some good diversification. Overall, you can see the loan originations were good in relation to Q2 of just last year. Very, very strong numbers overall. Nothing bad to say in terms of personal loans, student loans, and home loans. So we're just comparing quarter over quarter. They're actually pretty good when we compare overall. Now, year to date is not finished, of course. This is just one quarter, but overall, it has been making some good progress. And here you can see the credit performance of the business. Because SoFi is a bank and they do so much loans, we always have to take a look at the net charge-off rate. Here you can see the personal loans in gray. The net charge-off rate has been coming down, so the customer quality has been improving. You can see that the personal loan net charge-offs here, or sorry, this is without the sale of delinquent loans. The net personal one is the black line right here. That's been declining very good. Student loan net charge-offs, well, sadly, since, of course, we have the repeal of student loan forgiveness recently in the last 2 quarters, that's been having a bit of an uptick as well, but overall, not that bad for the business either. So not too bad, guys. You can see the average credit score here of personal loans and student loans. So the quality of the customer is pretty good. Both of those cohorts having mid 700s in terms of performance, right? So nothing more to say in terms of, tech. I mean, I guess we could look at Galileo right here. Net revenue 15% year over year, very strong. I showed it to you guys on this chart right here. That's the orange bar right in the middle. And of course, your contribution margin and profit staying relatively stable here at about 30% from the company's overall platform. So very strong, guys. The technology platform segment, they have more clients. It's been, right now in terms of quarter over quarter from 2024, 2 million plus, which means that, if Deutsche Bank has clients using this service, they count those users as part of this service right there. So you can see a very healthy 160 million users so far in 2Q of 2025. So looking very good here, guys. You'd be very hard pressed to pick apart this report and find anything negative with this company overall. One additional thing that they're going to be doing is they're tokenizing some of their loans. I thought that was interesting. Some guy brought it up here on Twitter when going through their earnings call, which I also noticed as well. Here's the excerpt. Here's the excerpt of the transcript, right? We remain incredibly optimistic about the loan platform business, which continues to move closer to becoming a $1 billion per revenue business. As we look further down the road, we see the potential to tokenize SoFi loans to make them more widely available in liquid markets in increments of dollars rather than tens of thousands of dollars, such that anyone can invest in loans just like they do equities. Little bit sketchy, but it's nice. It's going to be an extra source of revenue for SoFi. Essentially, they're tokenizing their loans, right? It reminds me of 2008. Just kidding. Just a joke, guys. It's not even close, right? The creditworthiness of the business is fine, but they're going to try and tokenize some of their loans. I thought that was an interesting segment for SoFi to be doing. So overall, guys, very good numbers. I mean, the focus on the improvements in profit margins should be front and center for SoFi investors right now. You can clearly see the progression of a company that went from negative net margins to now consistently positive net margins and consistent positive free cash flow as well. And the growth profile of the company is not going to stop right here. They're growing EPS very nicely over the next 3 years and growing revenue by a fantastic clip here over the next few years as well, which gives them the following metrics. They're growing revenue by an average of 18% per year for the next couple of years, growing EPS 50% per year, which gives them a valuation at $21 right here, the round trip figure. Is it a good buy, even in spite of the fact that it's rallied an absolute ton? Well, here's the facts, right? At $21, they're trading at a 67 forward price to earnings. When you divide that by their EPS growth rate, you get a PEG ratio of 1.35, which is okay. All things considered, that is okay. Forward price to sales as well is about a 7.33. Not too bad for a fintech company. Those usually trade between 8 and 10, and the PEG ratio is fairly attractive. Essentially, what I'm saying here, guys, is if you have a long-term time horizon on SoFi, such as the next 2-3 years, I would not be surprised if this company can expand its market cap just because it's adding so many clients, generating so many different sources of revenue. I really would not be surprised if this market cap, which currently stands at about 25 billion, probably can go to 30, 35, 40 billion at some point over the next 1 to 2 years type of thing. So even though you may not have the rapid gains as we've seen recently in SoFi, talking about a 2x in only 3 months, you probably will see some consistent gains over time. It might be a little bit of a volatile and bumpy ride, but I think the gains are on the table. So for you shareholders out there that are holding SoFi as part of a long-term thesis, I definitely do not see anything to worry about. As a matter of fact, I even would not mind adding to this company myself If we can find under $20 again, I'll probably DCA a couple shares. I did most of my buying on SoFi around the $10 to $12 range, not only here, but also a lot over the course of last year as well. My average cost, I really stepped up the buys. My average cost on my SoFi shares is right around $12. I'm holding every single share, and I would not mind adding, but just keep in mind, it's ran a lot, guys. You would not be surprised if this one can be volatile in the short term, but I'll remind you as well, right? Any consolidation is going to be healthy consolidation before probably a sure thing in terms of a next leg up. It's just the timing of the next leg up is up to interpretation. It could happen in the next 3 months, or maybe it takes a bit longer, but I think it's more of a sure thing than not. There's still probably a lot of decent gains to be had on the table for this company over the next 2, 3, 5 years. I like the performance of this one. Disruptive company, really starting to take some market share from your legacy banks out there. And that's everything I had for you guys for SoFi earnings. Now let's dive into earnings number 2, which is going to be PayPal. PayPal coming out with earnings today, this morning, as a matter of fact, and sadly, the stock was down 8.66%. Unfortunately, PayPal can just not shake this range. It's a fantastic company, but the stock price has been an absolute dog in recent years. And sadly, they still do not have much momentum to show for it. Now let's take a look at their earnings real quick. So EPS beat by 8% and revenue beat by 2.52. They actually had a fairly decent quarter. However, it was not perfection like SoFi. They missed on a few key metrics that they had guided for, which did contribute to the company coming down. Another example of a company that, even though they reported great quarterly earnings for this quarter, the guidance fell a little bit short of, or rather, some metrics fell a little bit short of expectations, and that was enough. As this market is a very tough crowd for these earnings, it was enough to bring the stock down 9%. Let's move into it, shall we? So taking a look at the article real quick, we will see here that PayPal stock sinks 8% as the company reports slow growth in key margin figure. Let's move into it. Sales increased 5%, so that was not too bad, as the new CEO, Alex Chriss, worked to roll off lower margin revenue streams. He's actually been doing a very good job at that since he's been CEO over the last 1 year's worth of time. Transaction margin dollars rose 7% for the 6th straight quarter of growth, which was pretty good. However, growth in that metric slowed sequentially, meaning quarter over quarter, down from 8% in the first quarter. Transaction margin dollars, guys, is essentially like, you guys know that PayPal processes a ton of payment volume, over $450 billion to be exact. But not all of that is their actual revenue for the company. That's just the amount of payments that they process. Transaction margin dollars is the amount of money that PayPal makes after those transactions are processed, so meaning all of the fees, right? So that's the commonly used metric for evaluating PayPal's growth. Branded checkout volumes also slowed to 5% compared with 6% in the first quarter. Branded checkout is whenever you're on a website like Amazon or wherever, and you're choosing to pay with something, whether you pay with a credit card or PayPal, right? So that is branded checkout. Sadly, that was down. The company also saw its expenses rise and cash flow fall. Total operating expenses were $6.78 billion in the quarter versus $6.26 billion in Q1. This is a problem because the new CEO said, listen, we're not going to focus so much on top line revenue growth. We're going to focus on operating expenses, controlling costs essentially, and free cash flow. So obviously, when that is the premise for the future of the company and they miss on those two metrics, sadly, it's not going to fare too well for the share price. Adjusted free cash flow in the quarter was only $656 million, roughly 1/3 of what the street was expecting to see, a drop from $1.4 billion in the first quarter. Total payment volume beat estimates, however, coming in at $443.6 billion compared with the $433 that analysts had projected. So very nice increase there on TPV, but just not enough for Wall Street. Active accounts rose about 2% as well. Let's take a look at some of the earnings guidance from the company for this upcoming quarter. The company actually raised its full year guidance and the one for the quarter, now expecting adjusted EPS of $5.15 to $5.30. That was up from a previous estimate of $4.95 to $5.10. So they beat on this quarter and they raised for the end of the year and above the analyst consensus of $5.10, which is pretty good, guys, in terms of the full year guidance. The third quarter was a little bit, they raised the midpoint slightly. The consensus was between $1.18 and $1.22 for where that's actually what PayPal said they were going to do, compared with the consensus estimate of $1.21. So roughly in line, off by a little bit, guys, but not too much. You can clearly see this quarter, in terms of the drop, was all about that transaction margin, right? And also all about the free cash flow and the operating expenses that slightly crept up on the company. Let's move into some of the metrics from the company so they can see that, you know, they're priding themselves on strong execution across different profitable growth metrics, which is not too bad. But if you guys want me to give you the problem with PayPal, just a quick summary of the problem with PayPal, I'll show you a few charts before we get into the own company slides, where they're going to focus on, you know, over 20% Venmo revenue growth, mid-teens percentage global transactions on new checkouts, 60% debit card TPV, and, you know, focusing on, innovating to power the future of global commerce, investing in agentic AI, ads, crypto, and stablecoins. That's what they're focusing on. But what I want you guys to focus on is you got to dig a little bit deeper, yeah? Here is the transaction revenue for PayPal overall. This is the metric that Wall Street was complaining about. Do you see a problem with this chart? It's slowing down, and slowing down a lot, right? That is why PayPal just cannot get much momentum. They are not showing increases. It's fine if you have, you know, stalling total payment volume growth, but you want to be bringing that more to PayPal's coffers, right? More to PayPal's revenue. They can be processing the same amount of transactions, but if they become more efficient with their transactions and operating expenses, right? Well, this number should be growing faster than it arguably is, and it just is not right now. Other VAS, this is value-added services, that's not doing too bad. So when the company talks about the fact that they're focusing on the Venmo growth and other things of that nature, yeah? Well, you're talking about a very small segment of the company's business. That's the problem with PayPal right now. Number two, I want to focus on transaction margin, of course. This one too, right? So you can clearly see it has been upticking since Alex Chris has been taking over. But look at the number of payment transactions per active account, which is the orange line right there. Can you see a problem from 2023 to 2025? It's been stalling or going down. So sure, they're maintaining their user base. However, people are doing less transactions per active user. That's kind of not what Wall Street wants to see. After a phenomenal growth period for the last 10, 12 years, it's stalling and has been stalling for the better part of the last 2 years. And in terms of active accounts, which is the purple bar chart right down there, you can see they had very good growth from 2012 through 2022. But what's been happening for the last few years, guys? Sorry, my big head is in the way. There you can see some of it, right? It's been stalled for the last 4 years. This is the problem with PayPal. They have the same amount of active accounts. They're not growing that much. People are somewhat using the service less often than they were. And fintech as a whole, guys, is a very competitive landscape. Let me just show you a chart to illustrate what I mean. And it's this chart right here. Here are your fintech companies ranked by revenue growth for the next year estimate. Where is PayPal? It is all the way at the bottom, guys. This is like 20 different companies. Here you can see Dilo, Nu, which is the Brazilian company, Mercado Libre, ADN, which is a European offering, Shift4 Payments, right? Even Toast right here, SOFI there at 19% growth, Wise, Robinhood, Intuit even. They're even getting bested by Visa and MasterCard, which are like boomer companies, right? Even Square is almost double at 11%. So that is just not good enough for PayPal. They are the bottom of the pack, and the stock price definitely does reflect that right now. So with all that being said, let's look into some of their earnings highlights. And I'll bring you down to just one single slide, guys, that is probably going to show the full picture of where the company stands right now. I'll just first tackle the free cash flow, why they're down so much, essentially impacted by shifts in working capital timing. They have maintained their free cash flow guidance for the entire year at around 6 to 7 billion, which is not too bad, guys. In terms of free cash flow yield, if they maintain that by the year end at their current price, that would be a free cash flow yield of roughly 9.35%. That is fantastic. It's just the timing of that free cash flow for this quarter was a little bit off. The one slide that everybody, or the two slides rather, that everybody should be focusing on are these, right? Branded checkout online. They focused on that being a highlight. Well, has it moved in relation to the last 4 or 5 quarters? No, still only 5% growth, right? So P2P and other consumer, peer-to-peer and other consumer, 10%. Is it that much of an uptick in relation to some of the most recent quarters? Not that much, right? Payment service providers, 2% growth. Look how much that is down from last year, right? Now, branded experiences, 8%. Total TPV, 5% only, down a lot from the same time, roughly the same period of time last year. But 2024 was measuring very weak comps from 2023, but still no growth. I mean, just look at the extended chart, right? And you guys will clearly see what I mean when I'm talking about this company, right? It's just too flat for my liking. Venmo, something that they highlight, 12%, right? And that is up a decent amount from 10% in the last 2 quarters and 8% from roughly the same period of time last year. So that's not that bad. But here it is, guys. Here's the one slide. Focus on this one, yeah? Active accounts, only 2% growth. Monthly active accounts, right? So not only active accounts in total, but monthly actives, 2%. Payment transactions year over year, 5% decline. You can see several negative quarters here. And then we also have transactions per active account, which is down 4%. So, you know, looking at all these slides, you can say that, yes, the company is doing some good progress here on cost cutting. They're trying to improve free cash flow. They're going to actually allocate 90% of their free cash flow to buybacks, which at the current stage would be 17% of their float. They've already this year bought back 7% of all shares outstanding. But is it good enough? Is the business growing? They are just not growing fast enough, guys. Revenue growth for the next few years, 6.5%. EPS is doing good for them, but that's because they're doing so many buybacks. They are cutting expenses. They are improving margins where they can, but is it enough? That is always the question with PayPal. Is it enough to really generate some momentum in the share price? EPS growth will be good, but as I said, it's kind of fake because it's a result of buybacks. Some organic cost-cutting endeavors, right? Revenue, very, very, very soft here, guys. You're talking about a company that's kind of hit its total addressable market, right? As you can clearly see, total payment volume is not growing. The amount of active users is not growing. They have literally hit the peak of their total addressable market. Now they're just looking to maintain market share and improve operational efficiency. Sadly, guys, that is just not enough for me to buy PayPal for the long term. It's fine to swing trade. If we look here at $71, right, forward price earnings at 71 is 13.65. It's not very expensive. That gives them a PEG ratio of 1.13, also not that bad. Forward price to sales of 2.12, which is also pretty good. Free cash flow yield is the highlight for me at 9.35. But truly, for a long-term portfolio investment, it just doesn't grow fast enough for me, guys, right? It's just the case. You guys can clearly see from the chart. For a swing trade, it's not that bad. If we can maybe get some trades down here in the lower 70 range, then maybe carry them back up to 80, maybe 90, and maybe rising tides lift all ships. If the entire fintech sector catches a bid, because fintech has been somewhat weak, let's be honest, in the past 1 to 2 years, if they come back with the overall consumer in the next 1 to 2 years, I can maybe see PayPal trade back into the 100, maybe 120, which could give you a short-term double. I would go for a longer duration swing trade perhaps, but it's not a company that would buy and forget about it for the next maybe 5-10 years type of thing, right? So that's really the things that I wanted to clarify for PayPal. Or for anybody that's interested in buying this company, planning for a recovery story, you just have to understand that it's not the same company it once was. It is no longer a pure play growth company. That's everything I had for you guys for PayPal earnings. Now let's dive into earnings company number 3, which is going to be another fun one. It's going to be Visa. We're going to spend less time on this one because the analysis for Visa is very straightforward. So Visa had earnings coming out today after the bell, and the company was actually beating on EPS and revenue. Nice beat on EPS, 4.7%, and a healthy beat on revenue by 3.3% as well. However, tough crowd, even in spite of those beats and maintaining the guidance for end of year and stating that the consumer was very strong, even Visa, guys, even Visa, down roughly 2 to 3%, which was the expected move. So now let's get into their earnings, shall we? I'm just going to take you through some of the company slides because this company is my favorite type of company. It's a very boring business with extremely high net margins. This company generates over 55% almost net profit margins, which is absolutely ridiculous. And they're one of the more consistent and predictable companies in the entire market. EPS rising almost every single year and revenue also rising almost every single year. Such a powerful network in terms of Visa. Overall, their earnings, guys, there's really nothing to see here. Such a boring company. Every single quarter, they just do business as usual. Take a look at net revenue bump here, 14%. That is fantastic. Net income up 8%, earnings per share up 12% overall, which was fantastic numbers for the company. In terms of payment volume, 8% higher, very strong there. Cross-border volume total was 12%, very good. And processed transactions, 10%. I love going through Visa earnings, guys, Because there's literally nothing to see here. There's nothing to worry about, right? Total US payments volume growth, that is back to normal standards throughout the past 4 months. Processed transactions growth, very smooth in the low double-digit percentage range, which is very strong. Cross-border volume growth is showing that they're growing very nicely internationally. And I'll show that to you even more. Total payments volume growth, credit, debit, and total, very strong showings overall. This is Q3 essentially in relation to Q2, so very strong. Look at the international growth for Visa, guys. Absolutely fantastic. The US is kind of on par with what it's been doing in the past few years. International definitely has to be the highlight here. Last quarter is the blue right there. This quarter right here, you can see 9% credit, 13% debit, 11% total. Fantastic number for Visa overall. We can get into more numbers. We'll just go into total cards here. More credit cards, 8% to the upside, more debit cards, total increase of 7%. That's usually how much they add on a year-over-year basis. Overall, though, guys, there's really nothing much to say, right? Service revenue was good, 9%. Data processing revenue was good, 15%. International was strong. Other revenue, such as, card member services and stuff like that, 32%, very good. And client incentives, talking about those very juicy rewards and point offering systems that they have. Very strong, guys. Another $6.3 billion in free cash flow. And what do they do with that fantastic amount of free cash flow? Well, of course, they pay a very decent dividend. And they also do a whole bunch of share buybacks. Take a look at the buybacks that this company has been doing over the course of the past 10 years. Very consistent amount of buybacks. And if you're worried about the health of the consumer, maybe you are, but Visa has a lot of data, guys. And if they're not worried, I'm not worried either. Let's take a look at what they have to say. Here's the CEO. This is an earnings transcript summarized by Grok. The CEO had to say that he emphasized the consumer spending remained resilient across segments with no significant behavioral shifts despite macro uncertainties like tariff concerns and inflationary pressures. U.S. consumer spending was bolstered by strong wage growth and low unemployment, contributing to stable payment volumes. Cross-border travel spending continued to grow, though at a slightly slower pace due to easing airfare inflation. Visa noted steady consumer behavior, with retail sales rebounding and the consumer sentiment index rising, reflecting optimism amongst consumers. Macro challenges. Visa acknowledged challenges such as the geopolitical risks, regulatory scrutiny, potential tariff impacts. However, the company's diversified revenue streams, particularly in value-added services and global scale, were cited as strengths for navigating these headwinds. Very strong, right? Overall, Visa's leadership expressed confidence in its ability to maintain resilience through diversified operations and strategic investments, even as macro uncertainties persist. This is why I love being invested in Visa, guys. They are some of the best at the games that they play. They have been through various macroeconomic cycles. They always have extremely high net profit margins. Sometimes cyclically the company will fluctuate, but overall, you can arguably not find a more consistent chart in the entire market. I love, love, love this company because of the net margins, because of the free cash flow, because of the share buybacks, and just the sheer moat that the company has, them and MasterCard combined. So at 300 and how much are they in the after hours? They were like 345, something like that, right? In around 345. Is Visa a buy right now for a long-term portfolio? I do think so. The company usually always trades a bit rich because it's so consistent, so profitable, and so predictable. Forward price to earnings at 345 is about a 30.13. It's very rare, guys, to find Visa trading anything under a 28 to 27. So this is not too bad. Sometimes it gets as high as the mid-30s to almost 40 in a real bull market. Forward PEG ratio is about 2.51, which is high, but justifiable because of how solid the company actually is. And the free cash flow yield, arguably not the best, but like I said, very rare to find free cash flow yield above 4% because their free cash flow, it just increases every year, and it's a byproduct of the market cap, right? That being said, the only time you'll find this free cash flow yield number jump is when the stock price truly plummets, such as it did during the tariff sell-off. Visa right now for me is a buy. If they come back and trade down below at the 330 region, it is still a buy for me. Every single paycheck, if I can, I tend to add some shares and Visa and MasterCard for the long term, unless they're kind of pushing all-time highs. But when I can find them on a 5 to 8 to 10% pullback in the overall markets, I'm a big fan of this company, and it's one of my favorite holdings in my own long-term portfolio. And that is literally all I had to say for Visa, guys. It is literally just that simple, not that complex of a business to understand or analyze. Now, moving into earnings number 4, we're going to be taking a look at Spotify. So Spotify was a very, very big winner over the course of the past quarter. From the tariff lows all the way to the top, you're talking about 65% gains. When you're sitting on that many gains, and when you were, well, before today's sell-off, the company was sitting on year-to-date gains, guys, year-to-date of over 45%. They've now since given a lot of that back. But just to show you guys, when you are up a lot, you have to show absolute perfection in this season's quarterly earnings, or your stock is going to take a tumble. Do they deserve a 12% tumble? That's debatable, but they did miss on several key metrics, and the CEO acknowledged that there was an execution problem this quarter. Let's get into it, shall we? EPS, sadly, negative, guys, negative, and also negative net margins. That's not happened to the company. It used to happen to the company several years ago when they were non-profitable prior to 2024, but it has not happened since. They'd been having positive net margins from anywhere between 5 to 8%. This time, EPS actually went negative, and net margins actually went negative, 2% negative to be specific. So that is enough to bring the stock down a lot, and revenue missing by 1.58% as well. So of course, when you miss on both of those metrics, that's enough. And when the CEO acknowledges it's an execution problem, well, of course, the stock is going to come down 11.55%, especially when it's sitting on so many gains throughout the year. Let's get into some of the numbers, shall we? So here's some of the easy numbers for Spotify. Revenue was up 10% year over year, which was good. Monthly actives also up 11% year over year, which was also very strong. Premium subscribers, where they make most of their money, that was up 12% year over year, able to convert a lot of the actives into premium subscribers. And they had a very nice, decent beat on operating income as well, year over year, that is 53%. However, as you've noticed, we were talking about that lack of profitability this quarter. That was down in relation to the last 3 quarters overall. So definitely not the best showing. And you did have a slight downtick in operating margin for the first time in almost 2 years, such a substantial drop. There was one slight drop off from Q3 to Q4 of 2024, but not this sharp, right? That is a clear loss and a clear problem for execution. Take a look right here. Spotify drops 11% for the worst day in 2 years on weak guidance. Here's what they had to say. The company posted a net loss of 86 million euros, down from a positive net income of 225 million euros a year ago, which is also a topic that we just covered. Spotify said that higher personnel, marketing, and professional services costs and 115 million euros worth of what it called social charges contributed to the results. The company expects revenue to reach 4.2 billion euros compared to a 4.47 billion euro estimate from the Street account. Sadly, guys, that is not enough. That's the next quarter's guidance, right? The Street anticipated 4.47 and they came in at 4.2. So not only did they have a double miss this quarter, they missed on revenue, they missed on EPS for this quarter and on net margins, but also the guidance for next quarter was not that strong. Spotify said the forecast accounts for a 490 basis point headwind due to foreign exchange rates. We've been talking about that. We've been talking about the fact that it would be good for US-based companies, maybe not so much for European-based companies, though. For the current quarter, Spotify has said it expects to reach 710 million monthly active users with 14 million net adds. That is good. The company expects 5 million net new premium subscribers in the third quarter to reach 281 million subscriptions. I know it's a lot of numbers. Don't worry, I got you guys. I'll show you some charts in a little bit here. Spotify's advertising-supported revenues declined about 1%. The company said it sees promise in its advertising stack and demand given its strong user base and will focus on adoption and new tools in the second half. Some areas of opportunity include business and automated ads. Here's what the CEO had to say. It's really an execution challenge, not a problem with the strategy. While I'm unhappy with where we are today, I remain confident in the ambitions we laid out for this business, and we're working quickly to ensure that we're on the right path. So acknowledging the fact that just wasn't a good quarter for them. During the period, Spotify said it rolled out a request feature for its AI DJ. The company said engagement with its AI DJ has roughly doubled over the past year. So even Spotify leveraging AI playlists and an AI DJ. Its audiobooks feature expanded to 4 new countries during the quarter, and listening hours jumped 35% in the US, UK, and in Australia as well for audiobooks. So not too bad overall. So obviously you now understand what the execution problem was for Spotify. I'll tell you guys some of my concerns because Spotify is a fantastic company, guys. It's kind of like Netflix. It's very hard for people to cancel once they have their service. They are kind of glued to their service. And once they are in the ecosystem, you don't really have a lot of people that are leaving overall. The one main concern that I have for Spotify is kind of like a concern that people were having for Netflix is what is actually their total addressable market, right? So I'll show you a graph right here. This is their premium subscribers and total monthly active users. You can see they had a phenomenal growth, kind of like PayPal here, but the growth is slowing down. It's getting incrementally better, which is good, but the growth is clearly no longer there. That's for their total monthly active users. In terms of premium subscribers, we've also had a very net uptick here in terms of monetizing their customer base, but we can clearly see a slowing of that growth rate as well. Now, this purple line right here is the monthly premium average revenue per user, ARPU, and you can see that that has been flat as well. So they are monetizing in terms of proportional, right? They're getting more users on their platform. They're able to monetize roughly the same percentage of those users, but is each user becoming more and more profitable for the company? As a result right now, no, which is why they're trying to use different things such as AI and different sources of advertising to bump that up. That is what you need to focus on if you are a Spotify shareholder. Now, moving further into that, this one chart will also paint that picture. This is a chart of consumption of new consumer media that is growing fast, but it hasn't proven to be as profitable as legacy formats have. Take a look at audio right here. This is the amount of consumption hours, 1.5 trillion hours. This is between live streams, digital publishings, people reading print, gaming, social, audio, streaming, linear video as well. And you can see that in terms of audio, that's a lot, guys. It's 23% of total consumption. However, even though people are consuming a lot of audio, are the companies able to monetize that audience as well as other various segments of consumption of media? And the answer, sadly, is no. So here you can see it has 23% of overall consumption, but only 7% of the total revenue pie that generates $570 billion of revenue per year. So we can clearly see that audio might just be kind of tough to monetize. They do a very good job of monetizing in terms of premium features, extended playlists, able to skip over certain songs. That's for sure, right? But can they do better than that? Can they throw on more features that'll make you pay even more? Arguably not. Matter of fact, audio struggles with this, not just Spotify, but it's an overall industry problem. They're not able to monetize their consumers as well as maybe other companies such as Facebook or Google with YouTube are able to do on their own end. These are just facts, right? It's just a question of audio. So that is also something that I found fairly interesting for the company. Now, in terms of the guidance, we already saw the guidance for monthly active users, 710 for the next quarter. In terms of total premium, that is up as well. Total revenue, 4.2, which was below the expectation. Gross margin being maintained at about 31%. It's not too bad, guys. I'll show you the margin progression for Spotify. It's actually been quite good, right? Although they did miss this quarter, you can see that the gross margin progressed, from roughly, this was 2023, right? Q4 2023. You can see the margin progression right about there, right? Started off at 26, now moving into the low 30s, which is very good. Operating margin has been having some nice upswings recently too. And they've done a good job of, driving more of that to the bottom line. But this one single quarter, sadly, has kind of unwound a bit of that progress. Curious to see if Spotify, the CEO did say that they would be able to kind of recoup these operating losses throughout the rest of the year, but definitely setting them back a quarter or two overall. That being said, I'm not worried for Spotify. It's just you really have to focus on that execution, which is what the CEO has been saying, yeah? In terms of EPS growth for the future, you can see very clean EPS growth for the next 3 years, but then analysts seem to be concerned that the growth might just be tapering off here come 2028. And the same thing for revenue as well. Very strong revenue growth from 2022, 2025, 2026, doubling of revenue, right? But from 26 onwards, you can see the revenue growth rate is slowing down. So the question that I have for you guys is, has Spotify kind of maybe reached its total addressable market? Have they monetized all the people that they can monetize? Have they driven up revenue per user as much as they possibly can now that it's been flat for the past 4 years? Those are all very valid questions and very valid concerns, right? Because we can just look at the company and we can say it's such a good company, right? But you always have to look at the pros and the cons. Here we can see, though, premium revenues have been increasing as they have more and more users, right? They also have pricing power. They're able to increase prices year over year, and people seem to be wanting to pay that. Advertising revenue, though, I would like to see them grow this one a little bit more aggressively, and the CEO did say that they will be focusing on that. We can see a clear progression of advertising revenue up and to the right. Obviously not growing as exponential as it once was, but up and to the right, I would like to see them get a little bit more revenue there because it's higher margin revenue overall, right? So that being said, guys, those are the main key takeaways from Spotify's earnings overall. Solid quarter, in terms of active users, in terms of the revenue growth of the company, but a few execution problems in terms of net margins and EPS and free cash flow, and that is going to send you down, unfortunately, 11-12% on the day. That being said, at $620 right now, is the company a buy? Let's have a look, right? In terms of forward PE, very expensive. If you only look at forward PE, you're not going to get the full picture, right? Because they're growing EPS at 30% year over year, but this is going to be slowing, okay? So keep that in mind. It's very important. So if you're willing to pay a two peg right now, with every incremental year, this EPS growth rate will be slowing down. Keep that in mind, right? So they are trading rich right now, but it stands to argue if the company maintains an average share progression, the company will arguably get more and more expensive as time moves on in terms of the peg, because the EPS growth rate will be slowing down, which is why you also have to pay attention how much you're actually paying for a growth company. Valuation matters, especially when your growth profile is going like this, right? High growth, and then they're kind of slowing down. That's when you got to be a bit more cautious. It's one thing to buy it here when they're in the peak of their boom of the growth cycle, right? But now when they're kind of hitting the tail end of their 7-8 year expansion cycle, you got to be a little bit more cautious than prior, right? Now, forward price to sales right now is about a 6, which is not bad for a technology company, and the free cash flow yield at 2.25 is a bit low. So is Spotify a decent buy right here? The answer is, I'm not really sure, right? Maybe if you have another 3 to 5 year time horizon, I do think that the company can just expand its market cap with if we just take average price to sales, right? If let's just say I take, let's say a 2028 price to sales figure here of 30 billion, and we give them a constant price to sales of, let's say 6, right? So 6 times 30 billion, that'll give them a total market cap by 2028 of 180 billion. We're at 124 right now. So by 2028, it can happen faster, right? But that'll be 45% upside if we keep constant price to sales. If you expand the valuation, well, then you can get higher than that. But you don't usually want to have to resort to multiple expansion to get more ROI. You would like the company to be able to do that on its own while keeping the same standards of valuation, since, it's not the cheapest price company right now. Spotify for me right now is a hold. In the event I somehow see it come down again, the last time we bought Spotify on the channel, I was very vocal here. 500 was a decent buy because the growth metrics made sense. Here at 620, it's debatable. It might be a little bit of a nibble for me, but it definitely would not be an all-in thinking that I'm getting a fantastic deal, right? Not a bad opportunity. If I have some long-term shares with a great cost basis and I'm up a lot, I don't see any reason to sell the company. You may as well just hold them for the long term. But if I'm looking to build a huge position on Shopify, thinking that their biggest expansion years are still ahead of them, well, I would kind of beg you to reconsider just looking at the tapering off of the active user growth rate. It's not that they're struggling, but their inability to drive more revenue per active user so far. They're doing a good job with advertising, but still, you guys kind of see the common theme that I'm trying to portray right here, yeah? So those are my overall thoughts on Spotify. Fantastic business, but just not the right price for me. I'd be more interested if, for some reason, guys, because anything could happen, right? If I see it down here in the low 500s again, that might be a better opportunity for me to go shopping for the company at somewhat of a more manageable valuation, right? That's everything I had for you guys for our earnings releases. I know we spent almost an hour on these, but these were some companies that a lot of you guys are interested in that I only really get to look at for a deep dive once every quarter. So hopefully that was very insightful for these companies, guys. Now let's move into some charts, shall we? So taking a look at the SPY right now, we can clearly see that, yes, the bulls are in full control. But as I've said, guys, the sheer amount of macro on the table for tomorrow and Thursday is definitely going to, and Friday, we're going to bring in a lot of volatility. And of course, due to the sheer size of the corporations reporting earnings tomorrow, talking about Meta and Microsoft, those could move the indexes quite a bit. So please keep that in mind, guys. Very tough to determine where the direction is going to go. It's going to be highly dependent on the macro releases and of course on the earnings. So the one thing that we do know for sure though is the bulls retain full control of this very smooth uptrend right now. Your higher lows are still set about 618. Pay attention to that, right? If we start sliding and give all of this back, you open up the door for a bit of early August consolidation, and that would also be in line with seasonality. We know that August through September and October are very choppy months. We're coming off a very hot July with not that much negative news. Any negative news will be magnified, especially when the market is priced to perfection. If you get the daily downtrend, you are going into very healthy, keyword healthy, weekly consolidation where the bulls are in full control of this chart. You're just going to be looking for a weekly higher low, anything above 593, looking for a weekly higher low. And if we get a sell-off, guys, it would be completely natural after this size of the rally and speed of the rally. 30% plus in a quarter is definitely nothing to ignore, right? If you do get a pullback, guys, probably around the 12 EMA is where the bulls will step in. 610 out of 600. I'm not saying it's going there. I'm just saying if you start a consolidation period, don't be surprised. And where you could expect some buyers to really step in might be down there. Moving on to the Qs, same thing on the Qs, right? The daily bulls are in full control of this chart. Your higher lows are set right here at 558. Daily uptrend is nice. In the event you forfeit everything and lose the 12 EMA, which the bulls have held now for an entire quarter, well, that'll be the start of possibly a daily downtrend and the start of a very healthy weekly consolidation. If the macro is bad and the big tech earnings are just not well received, the big tech earnings don't have to be bad, right? They just have to be not well received by the market. I gave you guys tons of examples earlier on in the video where earnings have just not been well received because companies have ran so much. Meta and Microsoft are companies, arguably, they have ran an absolute ton. We're going to get into them in just a couple minutes after the indexes, right? But Microsoft as well, right? It's their game to lose right now. And if they go down, they will drop the indexes and will drop the Qs. If that does happen and we go into some form of a daily downtrend into the early August period, just understand what you're looking for. Healthy market consolidation at this point, anything above 524, looking for a weekly higher low for possible further trend continuation. Moving on to the XLF right now, financials down a little bit. We'll see how Visa's earnings plays into that tomorrow, but just looking for a higher low on the daily. Yeah, anything above 5132, higher low possibly for some trend continuation. And if we don't get it, and this one unwinds with the rest of the market, just understand what's going on here. The bulls are just looking for a weekly higher low, anything above 5128. They're still in control right here, yeah? And just looking for a higher low, tons of support below. Even if we come down into here and kind of tighten up in some form of a tight range of consolidation at the previous all-time high resistance, that's all support. 52.12 down to 50. You have to break this level down here to get me the least bit concerned on financials. Moving on to healthcare right now. Healthcare down pretty much. We had UNH earnings. Eli Lilly falling off a cliff because of the sympathy play from UNH reported earnings this morning. You can clearly see that right there. Some of the pharma names were not too bad, but UNH and Eli Lilly kind of just bringing down the sector. So this one's still very choppy, guys. Still an accumulation period, tight range. If you want to see this sector expand, you need a weekly close above 137. So something's going to have to happen that this sector really gets a jump above 137. Then you can say the bulls are in control of the weekly, and then we can actually get started on a monthly upswing back into maybe the resistance range of about 147. So far, though, bit of consolidation into the support range, which is 136 down to 122. I'm still a fan of accumulating healthcare here. I'm not buying any individual names, but I will buy the entire sector as it has been lagging behind the S&P pretty considerably now for a few months in a row. Onto semiconductors, the only bright spot of the entire market today, and that is even without the help of the sector leader, which is NVIDIA. Well, they were up about 0.51, but the candle doesn't look too promising. We'll see what happens. Daily uptrend is obviously well in motion right now. Pay attention to the higher lows, 283. In the event we come back down with everything and break this low, well, sadly, guys, without a close above the previous highs, that would be a daily downtrend, a loss of a 3-month 12 EMA. And as a result, if we progress into a daily downtrend, you're looking for healthy weekly consolidation, maybe back into the prior all-time highs around 275 or a bit lower down here, 260 to 250. You can take a look at the SOXX as well, and you'll see the SOXX is a lot closer to its more relevant area of prior resistance, which will now be support, 234 down to 222. The difference between the SOX and the SMH is just the amount of weight that they have in the top holdings, but you can clearly see a pattern here. If we come down, we're looking for a weekly higher low for further trend continuation. If we do move a bit lower, because semis have been our sector leader, our market leader, if you lose the market leader and that bull flips the bear, you're definitely going into weekly consolidation, and I will be a big fan of buying a lot of my favorite semiconductor companies on that weekly dip. Moving on to the Russell right now, the Russell down about 0.64%. Not the worst day for the Russell, just consolidation range right now. Unable to break the resistance, 225 up to about 232 is the resistance range. In the event that you lose this area and go into a daily downtrend, you'll know that weekly consolidation is likely underway, and you may just be looking to backtest these guys down here, 216 down to 208. I mean, the bulls, they're not looking too bad right now. It's been a heck of a rally on the Russell. Any consolidation, probably just going to dive back in to the support range, into the EMAs, maybe get a bit more momentum for an early August sell down or take profits, and then maybe we can start a next further upswing as we get closer and closer to the September rate cut. That's everything for your sector rundown right now. We can talk about the VIX. The VIX was up 6.18% today. I mean, obviously, guys, when you're talking about the busiest week of earnings, whereby 39% of all companies will be reporting earnings, and you're talking about the busiest week of macro that we've had in a couple weeks now, tomorrow GDP, Powell, the day thereafter, we're going to get some other core PCE numbers. On Friday, we get non-farm payrolls. Of course, there are some volatility catalysts, so you wouldn't be surprised if any of those are negative to see the VIX uptick a little bit. Is it going to shoot all the way up to 30? No, but can we see an uptick here? Yes, and that'll be beneficial to you guys if you're looking to sell some puts, the strategy that I love the most. If you're looking to sell some puts, you may be the beneficiary of some increases in volatility, which will be good. Increases in volatility are usually coupled with a drop on the SPY and QQQ and a drop in the overall market. So when the market dips and you get some increases in volatility, if the stock's coming down there, well, when the VIX is low, when stocks are moving down, when you write puts, you only get very close, right? Because the volatility is super low. Now, you might be able, for the same premium, you might be able to get considerably lower. So that's what I'll be looking for. Drops and heightened volatility is the name of the game when you're looking to sell options overall. Now, that being said, that's everything. We'll go over yields and all that tomorrow after Powell. In terms of gold, well, gold is still just doing a whole lot of nothing, guys. There's literally nothing to see on this chart, right? We tried for the daily uptrend. They unwound everything. We will see if tomorrow the volatility catalysts are bad, such as earnings and such as macro, you'll probably see gold to have a little bit of a bid here. And if we do catch a bid, we are going right back up into our resistance range, which currently stands at roughly, let's call it, I don't know, 34 down to 33.60 roughly. But overall, guys, we're just kind of trapped in a range. Be very careful, though. If you break down below this guy right there, that would be a weekly downtrend. If you flush this guy, 32.60. If you flush that guy, watch out. Weekly downtrend, you've not had a weekly downtrend or a loss of the weekly 12 EMA in 6 months plus. That would be monthly downtrend consolidation. So please keep that in mind. I'm not really playing gold right now. I'm waiting for the bulls or the bears to make an actual trending move and break out of this range that we've been stuck in. It's been some awkward tightening range for the better part of the last 3-4 months. Now moving into Bitcoin. Bitcoin also didn't have the best day overall, but we are still consolidating at the highs right now. Same concept, right? Bitcoin, yes, sometimes it likes to move on its own, but other times it is correlated to the markets. Tomorrow, if earnings are not well received and if macro catalysts are not well received, you probably know what's going to happen, right? We're probably going to flush these lows. Pay special attention to 116,500. If you break that, that will be officially a daily downtrend, and you're going into very healthy weekly consolidation. The bulls might find more support in the area where we just broke out of, right? Talking about those guys back there, 111 down to about 109. That would be a new buy condition for me. Just looking for a weekly higher low, anything above 98.8, looking for a weekly higher low, maybe coming into the 12 EMA, which is also confluence with the former resistance range. Bitcoin's not looking too bad. The bias is still bullish, so if everything tomorrow goes good, the bulls are still in control. They haven't lost anything. We're still looking for the breakout towards 125, but this one is going to be catalyst dependent. So keep that in mind on Bitcoin for the next few days in motion. Now, that's pretty much everything for our market analysis. Now, let's do some of these big tech names. Okay, so we're going to run through these a little bit quickly, and I'll give you guys my honest thoughts as we approach earnings. So Apple has earnings on Thursday. Today, they were down 1.3%, getting rejected again from resistance 221 down to 213. But the short-term price action does not matter. They might be impacted from the moves on Meta and Microsoft tomorrow, which also have earnings, right? Meta and Microsoft, but they're probably going to move more on their own earnings, let's be honest. The expected move on Apple is 3.65%. 3.65% to the upside is probably going to put them at the top end of the resistance range and maybe give the bulls a chance to proceed into this weekly leg of expansion. In the event that earnings are not good and the company gets shot down again, we'll be coming right back down into support, which is going to be, in my opinion, a buying opportunity. Anything close to the $200 mark could be a decent area to play some short puts under the market, or maybe accumulate some positions, as Apple has notoriously been left behind from the overall year-to-date rally. The company is still down almost 16%, so there could be some opportunity here, but it's very tough to get a sense of which way this one's going to break until we, of course, get those earnings. Most of the earnings impact, in my opinion, is going to be from the iPhone sales, of course, and their revenue growth rate. There is going to be some talk about the tariffs, but it's all going to be about the iPhone refresh cycle. Is the 17 slated to be better than the 16? How are their net margins? Of course, they're going to do a great deal of buybacks, but also the AI story, right? On to AMD right now. AMD up 2.18%. This push is absolutely insane on AMD right now. However, we are coming into daily overbought conditions, and we are coming into the take profit area. Overhead resistance. This is an area that has notoriously been very challenging for the bulls to get through. They did it once back here in March of 2024, but not since. So after such a tremendous rally, guys, from the bottom to the top, 135%, that is a lot, right? Any swing trades, I was telling a lot of my Discord members today, this is a take profit zone, not for maybe all of your contracts, but for a lot of contracts, right? Decent take profit zone as we approach their earnings cycle, which will be, of course, next week, next Tuesday to be specific. Very strong move by AMD, overbought conditions. In the event that we get shut down from here and move a bit lower, well, we're obviously looking for a daily higher low, guys, yeah? Anything at this point above 149, looking for the daily higher low for possible further trend continuation, but there's not that many days of price action left for AMD before their earnings. I think they'll have very good earnings. They'll show some fantastic revenue and EPS growth rates. I don't think this story is finished, guys, especially if you have a time horizon into 2027, 2028. I do not think this growth story is finished at all. If anything, it's just getting started, right? EPS, phenomenal ramp, revenue, phenomenal ramp. And we just saw yesterday that they were increasing prices of their data center chips, the MI350s, by 70%, which will give them a great boost in net margins and free cash flow as well. On to Amazon right now, down 0.76%, but doesn't really matter, guys. Amazon has earnings in 2 days. So the expected move on Amazon is going to be, we showed it yesterday, but just to reiterate, expected move on Amazon is going to be 4.57% up or down. So 4.57% to the upside is going to be almost new all-time highs. 4.57% to the downside is going to be testing the bottom end of support. Amazon is looking very, very strong right now in terms of the price action. The bulls remain in full control, but there's almost no days left before their earnings. I'm not expecting Amazon to break the all-time highs before earnings. I'm also not expecting them to drop below the support range. It'll be a question of how they perform after earnings. One thing is for sure, though, I accumulated as many shares of Amazon as I wanted prior during the tariff sell-off and some leap call options too, all of which I am holding in the event we get an earnings sell-off, because that's what everybody's concerned about, right? Not necessarily an earnings push, because that'll just be, just normal practice for Amazon, but in the event of an earnings sell-off, like a Netflix or like Google, where it pops up a little bit and then just gives it back, I will be a big fan of playing the wheel on Amazon. Anything below 215, I'll be a big fan of playing, looking for this weekly higher low to be established by the market on any consolidation. And I'll also maybe be looking to pick up a few more shares for the long term, as the long term for Amazon is probably looking very bright in my opinion. We'll cover their earnings on Thursday together. On to Google right now, a bright spot of the market, 1.56% to the upside. Finally getting a little bit of lift after that earnings, right? Daily bulls remain in full control right now. And obviously, guys, Google is going to be affected by the big tech earnings and by the sentiment around them. But good thing the bulls have a lot of space. Anything above 181.52, just looking for a daily higher low. And we got a lot of support below 190 down to 180. In the event that Google pulls down again, right? Well, obviously, we're going to understand that it will be for a buying opportunity, as our longer term bulls are in control of this weekly chart. The weekly chart is looking gorgeous right now. A lot of space above 165. Any pullback, looking for a higher low. If we come back down into support, I'll be a big fan of selling some puts down here, lower 180 range. I haven't done it on Google in a while. I'll be looking forward to do that if ever we get some discounts here in the next few weeks. Their earnings were fantastic. We covered them on the channel next week. Google is still very fairly priced for their forward growth metrics in the next few years. On to Meta right now. Meta down 2.46%, but I mean, it doesn't really matter, guys. They have earnings tomorrow, right? So earnings on Meta tomorrow. Front and center will be the CapEx and how much money Mark Zuckerberg spent on hiring people, which is a lot of money. Their expected move is 5.38%. So whatever happens tomorrow throughout the day arguably will not matter. One thing's for sure, though. If they have 5% to the downside after earnings, you're heading right back down there to 660. If they get a 5% bump after earnings, well, you're heading almost back up to the all-time highs. Price action will make that determination tomorrow. I have bought all the Meta shares that I wanted to during the course of the tariff dip. I am now just riding. No short-term swing trades for me into earnings. I will just gladly sit, wait for the earnings result, and in the event that we do consolidate after earnings, guys, you're literally just take a look. When in doubt, zoom out, guys. you're looking for a monthly higher low, just a bit of very healthy consolidation for Meta. The valuation in around 700 is not that bad. If it does come back down to the mid 600s, I'll be a big fan of adding to my Meta position. I'll cover this earnings tomorrow for you guys on the channel as well. But just so you guys know, no pre-earnings positioning for me, especially not in this environment. I'd rather wait until after earnings moving forward. On to Microsoft right now, same concept as Meta. There's not too much to say here. The company has had a ridiculous rally, and we know that a lot of companies that have had phenomenal rallies leading into earnings, well, sadly, even if the numbers were good, if they were just not perfection, well, they've been sold off. So don't be surprised if even if Microsoft has good earnings tomorrow, if it's not absolute perfection to justify this ridiculous move from the bottom to the top, 48%, well, you might just be getting a little bit of sell down activity. Pay attention to the 12 EMA right here. If you flush 500 after earnings, no new highs in terms of closes above the highs. Daily downtrend, loss of a 3-month 12 EMA, might just be some profit taking for retail and Wall Street, and start a very healthy weekly consolidation process, to which the first stop would be around 487, and then a little bit below here, 470, the previous all-time highs. That would just be very healthy weekly consolidation, right? For a bit of a monthly pullback, maybe leading to the fall, we get a consolidation phase for Microsoft. I am not positioning for any swing trades into earnings. I'm also not adding any shares. I did all the buys that I needed to all throughout last year at the range lows. I was telling you guys all throughout last year that it was decent buys and through the tariff sell-off. And now we're just kind of riding what we have. If you missed the boat, you missed the boat, but you may as well kind of wait for consolidation because now this stock is fully priced. On to Netflix, the poster child for great earnings, but just been down ever since, right? Unwinding this fantastic move. This move on Netflix from the last quarter, guys, was also 61%, right? Nothing bad happened to earnings. We covered it on the channel. Daily downtrend clear as day right now. Backtesting resistance, which is 1214 down to 1180. If big tech or macro is bad tomorrow, you can expect some further slides on Netflix, especially they've been unable to reclaim the support range, which is now resistance. Might just be looking for a little bit lower. That being said, if we do move lower, it is still a weekly leg of consolidation. And where could you be heading? You're just looking for a monthly higher low, right? Just looking for a monthly higher low. Where could we be heading? 1,070 down to roughly $1,000 would be an area that I would consider maybe adding a little bit more to my Netflix shares. I have not touched this position since the lower 800s, which is the last time that I added, but I would be looking forward to add to this company if we make our way into the $1,000 range over the next few weeks of time. On to NVIDIA right now. NVIDIA down 0.7%, not that much. The stock is in full control of the daily uptrend right now, looking for a higher low, anything above 164, looking for a higher low for possible further trend continuation. But if tomorrow's bad, you guys know the drill, right? If tomorrow's bad, if big tech earnings are bad, and NVIDIA gets dragged down in the mix, just pay attention to the loss of this 12 EMA. That'll be the first time that they've lost it in over 3 months. And if you pull back too much, you open up the door for the daily downtrend and just very healthy weekly consolidation. It's been how many weeks in a row of green? Healthy consolidation is always on the table, and it is just that. Healthy consolidation. First stop, 154, which is your 12 EMA. Second stop, if it really gets a little bit spicy in terms of the sell-off here, 150 down to about 145. That'll be from here down to there, 12%. I know some people say it's not possible. Guys, you've seen NVIDIA. It can drop 6% in one day, and still nothing bad is happening with the company. It'll just be a byproduct of the entire market selling off. In around 170, guys, the valuation is not terrible. It's not the best, but it is slightly on the more expensive side. If you ask me where I'd be looking to add more to my NVIDIA position, if we get the pullback, but I'm kind of not going to buy up here and just chase the market perpetually. Not in the business of doing that. Moving on to Tesla right now, down about 1.35%. Nothing good on Tesla happening right now. We're just stuck in a range, guys. There's no clear price action here. Overhead resistance, 360 to 340. Below support, 300 down to about 258. This one will kind of move with the rest of the market, guys. If everything's good tomorrow, Tesla can catch a bid and attack resistance. If it's not, it's going to retest support. All you need to know, tightening range right here. You're going to look for it to break one way or the other. I will not be participating in Tesla until we make a move on price action. If we come down towards the lows, maybe we'll scout some buys in lower time frames, and we'll tackle that when we come to it. If we break out and retest, maybe that's another opportunity for some swing trade longs. But as of now, as it's tightly consolidating, guys, just no swing trade opportunities for me. And you guys know in terms of long term, right? If you're investing in Tesla for the long term, you may as well have a 3 to 5 year time horizon because that's how long it's going to take to ramp their long term offerings. On to Palantir. Palantir down 1%. And this is another company, guys. They have earnings on Monday. If Palantir at this valuation and having rallied this much since the April lows, talking about 136%, If these earnings come in anything other than absolute perfection and net increases in guidance and revenue run rates, what do you think is going to happen to the stock? Well, of course, it's going to come down, even if the numbers are good, right? That's just been how Wall Street has been operating this entire earnings season. So keep that in mind. Daily uptrend is nice for the bulls right now. Anything above 145 looking for a new higher low, but not that many trading days left for Palantir before its own earnings. In the event that we pull back either before or after earnings, you got a lot of space. Anything above 129 looking for a weekly higher low for possible further trend continuation after. But if their earnings are not perfect, I mean, we'll cover them, right? I'm pretty sure they're going to be good, but if they're not absolute perfection, you can see the common theme here. They will get sold off, so please keep that in mind. Talking about SOFI, we covered their earnings earlier in today's video. That being said, though, guys, they have round-tripped everything in the after hours, right? Absolutely everything, trading around $21, which is roughly here. That candle and tomorrow's candle is not going to look the best, right? The bulls tried to go for one last push, got rejected, sadly. The cleanest time frame, in my opinion, in the event that we lose this 12 EMA, which the bulls have been riding, many charts have been riding this since the month of May. If you lose that and start unwinding, and once again reject that resistance 22 up to 24, if you reject this, guys, it's just going to be very healthy consolidation and probably a tremendous buying opportunity. At that point, guys, you're just going to be looking for a bit of consolidation. If we can find SOFI again in the 18 to 17s, if the overall broad markets go into consolidation, I'll be a big fan of picking up some more SOFI. You know, 19, 18, 17, I'll kind of start DCAing into a bit of a swing trade for some longs for Q4 and into 2026 as well. That's how I'm going to play this one with a longer term time horizon. But as of right now, this was a clear take profit area. So hopefully some of you guys, and I know a lot of you guys, you've been, flaunting the call option gains. Hopefully you're able to take some of those off the table, because I know a lot of you guys were working with August or September or November expiries. Not the worst time to take some profits. Hopefully you guys did take that today. It was a glorious opportunity to do so. 17, 18, 19% early morning with an increase in vol. I'll take that every single time. Moving on to Uber right now, down about 3.85%. Uber, same concept, right? We were noticing that the bulls were weak, right? Daily uptrend, giving back the entire move. They tried to go for it. And we were saying if they lose this area, 92 down to 90, lose this, it's a daily downtrend. And sadly, they're going into weekly consolidation. The bulls at least have tons of space. Anything above 82, well, they're running out of space now. If you come down a little bit more, guys, you might just get trapped in a range of consolidation. Uber has earnings coming up over the next few weeks. I think, as a matter of fact, next week. Yeah, next Wednesday. So not too many days of price action for them. One thing's for sure, though. If I see Uber come back down here, low 80s, I will be playing this stock. I probably am not going to be playing it before earnings, but if I can find it after earnings down here, once again, if they have good numbers, but the market just sells them off regardless, I'll probably be playing them down below in the low 80s. Just, they have very good valuation down there, so I'll be interested. We'll cover them after earnings, but no plays from me on Uber before earnings. And lastly, TSM. TSM down about 0.58% today. So sadly, not doing too much after their own earnings. Pay attention to this guy right here, 232. If you lose that, and in combination, you lose the 12 EMA, which they've held since May, of course, right? If you lose that, first daily downtrend and first loss of the 12, which means you're into weekly consolidation. All of these charts can use some very healthy consolidation right now, which is why I have so much buying power leading into the next few weeks. That being said, if we do pull back here, because everybody's not concerned about further gains, right? People are just concerned about a pullback out of weekly overbought conditions and somewhat, softening momentum. That being said, if we do come down, pay attention to 220. How do we react from 225, 220, prior all-time highs? That'll be a very nice hunt for a weekly higher low. Anything above 205, looking for a weekly higher low for possible further continuation into the end of Q3, into the start of Q4 as well. The valuation of TSM is decent at 245. It's better at 225, and you may even see me build some swing trade longs if we do take a bit of a leg down. But what I'm not going to do is build some swing trade longs here. I got all my TSM shares that I wanted to during the tariff sell-off, and I pretty much stopped buying when it came back above 200 because I was pretty much full at that point. Now I'm just riding the long-term shares that I've accumulated, but any more swing trades will come into play from me in that area right there. And that is everything I had for today's video, guys. Sorry, the video is so long. I can't really do the biggest gainers and losers of the day. I mean, I guess I'll give you some because I know some of you guys want my impressions, right? NVO, is this a buy? I'll just be very simple with it, right? Yes, I mean, it's not a buy, but here you go, right? 56 down to 49. Yes, it is current support right now for the markets, but competition's heating up, and NVO is right now a one-trick pony, guys. Healthcare stocks, I'm not the biggest fan. When do you guys ever see me play healthcare stocks? I rarely ever play them. If you're buying NVO, you should be buying with a 2, 3, 5-year time horizon, because that's the time that's going to take if you truly want to see the time. I mean, they can start curling around, and as a matter of fact, they've been trying to. It's going to take a while, though, guys, to really start seeing those gains and kind of a clear path for the company, right? Moving on to UPS. UPS, sadly, guys, once again getting destroyed. The dividend yield is fantastic on this company, 6.5%. Next area of support, 85 down to 80. If it gets down there, I'll play it again, but since we flushed, we're going to have to wait for consolidation down there. That'll be prices that we haven't seen since 2012. I might be interested, but as of now, I'll let the earnings move kind of consolidate a little bit. UNH, I know everybody, because I didn't cover their earnings, everybody's going to ask for UNH. Maybe I'll do them for you guys on Friday. Is UNH a buy? Not for me, guys. If you guys want to buy this one, I was talking about this one in my Discord today. The problems that they have are out of their control. It's just out of their control. They cannot do anything to counter rising medical costs. They cannot do anything to the fact that a lot of their customers in the last year have been claiming, right, for medical insurance purposes. They've just been going in for procedures and stuff like that, things they've pushed off since COVID. And now everybody's claiming their plans, right, for medical insurance services. They can't do anything. Their customers' premiums have been locked in. Their contracts were signed last year. They cannot do anything to fix their current situation. They guided for EPS, a huge guide down on EPS for this year. This one is a multi-year turnaround story. Yeah, the valuation's cheap. Yeah, it's broken through all the technicals. Yeah, it's oversold. I agree with all of those facts, but just understand it can go lower, and any buys you make today, you should have a recovery timeline by 2027 to 2028. They said recovery of growth by 2026, but they do not mean growth overall. They mean growth in relation to this year, not coming back to the growth that they once had in the years prior. That is going to take some time, guys. And it's not just me, right? Just look at the EPS. Just look at the EPS. When will they achieve 2024 EPS again? All the way in 2027. This is a multi-year recovery story. As a result, that's how you should view it as well, right? There's so many other names on this list down here. Reddit has earnings on the Friday session. Trade Desk pulling down off the highs. This one, if we consolidate a little bit, back down the mid-70s, I'll probably be a buyer. I know I'm kind of running through them very fast, guys, but I just don't have time. The video is like an hour and a half long. So many earnings to take a look at, and I'd rather focus on earnings, even the ones to the upside, like a lot of earnings plays here, of course, Waste Management, Cadence, right? CBRE as well. Equifax recovering a little bit from their earnings. HIMS benefiting from the NVO disaster because they're the ones selling the compounding drugs. Equifax is a buy, by the way. If you're looking for a great high quality company in a support right there, I said it after earnings, last week type of thing. But other than that, guys, there's not that many more. Oh, and Melly is definitely a buy for me. Melly is 100% a buy. Growth ratios are fantastic for this company. I've been adding more to my long-term portfolio here. And if we move lower for some which reason after earnings as well, which is next week, I'll be covering it. If we move down 2100, it's even more of a strong buy, but I don't even mind adding some here into earnings and adding more after. No swing trades with call options because they're super expensive, but Melly for me is a buy, so I figured I should slide that one in there, but just not enough time here today, guys. Spent a lot on the earnings. So hopefully you guys enjoyed today's video. That's all I had for you guys today. If you did, I put a lot of work into these earnings. It takes me a long time, which is why the uploads are late at night. It takes me a long time, guys, to go through the earnings slides, derive what's happening with the companies, derive a thesis, something manageable for everybody to understand. So if you guys enjoy this type of content, please drop a like, would really appreciate it. Also subscribe to the channel as well if you enjoy this type of content. And last but not least, if you have any questions for me, feel free to leave them down below in the comment section as well. That's all I had for you guys today. You guys know the drill for the Discord. The video is too long. I won't spend 2 minutes presenting it. But if you wanted to participate in our trading and investing community, trade with me every day in our live streams, ask me questions, have access to all my trades, and just participate in a very a high level group of members overall in which we trade the markets very consistently, but also build very high conviction long-term portfolios. Everything wealth, everything investing. You guys know the drill. The link and the description of the service is down below in the video description. Hopefully I see you guys in there soon. If not, I'll see you right back here on the channel. Take care. That's it for me. See you tomorrow after the close for another busy earnings day. Peace.